Now, signals continue to remain bullish on the S&P 500 and the NASDAQ as warning signs continue to flash. We got more warning signs today. I told you going into this week, last weekend, and at the beginning of the week, two things are going to be a factor this week: the Fed and options expiration. We got triple witching. Really around that time, with triple witching on options expiration, institutions like to play games. We're getting this rally right after the Fed, after initially we got volatility surrounding Powell's kind of hawkish concern. Even though they penciled in two more cuts, Powell expressed concerns about inflation and about deterioration in the labor market. That's, inflation. When you got rising inflation and the economy is weakening, there's concerns about stagflation. Powell talked about that is a difficult environment for the Fed. Signals are still bullish on the S&P 500, but we're getting warning signs. We got more on Friday. For the S&P 500, the signals have been bullish ever since the bottom, except for here in July. We saw it turn briefly, and then on a few other swing trend signals and momentum, we saw a couple of signals turn bearish in August, but everything reverted right back to bullish. And here we've been bullish since just after the August 1st low, after we turned down on July 31st. Signals remain bullish. NASDAQ, we saw it turn back to bearish deeper into August, but again, still remains bullish at this time, back to bullish. And that's because we had a tech sell-off, ended up dropping 4.28%, but then signals reverted back to bullish and now making new highs. Nvidia's not making new highs, it's diverging with Nvidia. Got a topping tail today, another warning sign that I've been talking about. But here, again, signals turn back to bullish after the sell-off from the February high. Signals turn back to bullish. We started to see some volatility in after the July 31st peak and in early August there. Tried to reverted back to bullish, then tried it again. We ended up dropping 4.28%. The signals reverted right back to bullish after this lower low was made. So again, with options expiration, we have some games going on. Your price still going to see sell-off. Oftentimes, the Fed meetings mark tops and bottoms, sometimes continuations of the trend, but likely a reversal with the Fed meeting. The rate cut is already priced in, and again, the longer-term yields are rising despite the rate cut. The Fed, with the Fed funds rate, sets the short-term rates. The long-term rates are set in the marketplace, and they're ignoring what the Fed just did, and they're rising. That could eventually be a catalyst that triggers a sell-off in the market. Did you hear what I just said? The longer-term yields are rising. The 10-year yield, 30-year, and these mortgages, longer-term mortgages, those rates are going higher. It could eventually be that the two cuts that are penciled in get taken off the table. The market gets a sell-off, but then goes and makes one final high going into the fourth quarter, maybe early on in quarter one of 2026. But again, you're likely going to see some type of pullback, post-Fed sell-off, and in the final climax rally of the final phase of the blow-off top, which began back at the April lows. And you're probably going to see, once the market peaks and begins to crash, the Fed will panic. That's when you're going to get the jumbo cuts. If this is a one and done, and I told you, I think it very well could be, if we start to see the jobs report improve, inflation tick back up, then the Fed could go back on the sidelines and go into the wait-and-see mode. So we'll be watching. We're getting warning signs here, though. Signals remain bullish. If we go back and take out the lows of the Fed day, we'll see signals turn back to bearish on both NASDAQ and S&P 500. Is the long-term yields are ticking back up. They have a negative correlation. Since the stock market put in a short-term bottom. We had a sell-off on August 28th down to the early September low, and the stock market began to rally back up. Yields have been falling. This is the 30-year Treasury yield, currently having a negative correlation with the market. They're ticking back up. S&P is making new highs around options expiration. This is telling us if they're ticking back up, we could see market begin to reverse. As I said, again, oftentimes there are games surrounded by the institution surrounding options expiration, especially triple witching. 30-year here. Here's the 10-year. And again, since the Fed meeting, they've been rising. They're at 2-week highs right now. This is the 10-year. Again, it had a peak here right when the S&P bottomed out in early September. The S&P rallied up. Well, we bottomed out right here, went flatlined until the Fed, and then now we're seeing the 10-year begin to rise back up. Longer-term yields are not falling with the Fed rate cut, which again, that's short-term yields. Longer-term yields are set in the marketplace. If yields rise back up, often have a negative correlation with the stock market, we could begin to see the stock market begin to turn back down. Especially if we see the inflation data begin to rise even further, again, long-term yields could eventually try to go higher. We could also eventually see Jamie Dimon's crack in the bond market. We had the Nikkei sell off overnight with futures, and futures started to sell off a little bit and then recovered with options expiration. Seeing yields rise in Japan and the Nikkei dropping as they're starting to sell ETFs. And just a red flag, just a warning sign. Keep your eye on the Nikkei. Back to the 10-year yield, you've got a possible bullish falling wedge here. You've got the MACD turning back up. Yields are rising back up. The 10-year yield rising back up, which currently has a negative correlation with the market. Since the run-up in September here, yields have dropped and the stock market has risen. They don't always have a negative correlation. Right now, at the moment, they do. But yields are starting to turn back up, meaning the S&P can start to turn back down. This could be something we hear about going into the next couple weeks. If yields start rising next week and the week after, this could be part of a catalyst. Seeing strength with the dollar, we're seeing strength with the 10-year yield. These things have a negative correlation or tend to have a negative correlation with the stock market. But we're seeing this rise right here. I think that we're probably in a wave 5 right now. Wave 4 could have bottomed out right here. If we end up going up above this trend line right here and clearing the resistance zone, again, we could see Jamie Dimon's crack in the bond market happen. Weekly time, the stochastic is turning back up here in the weekly time frame at extremes. If Jamie Dimon is proven correct, if bonds are to collapse, we should see yields rise. That could give us a fifth wave here if this is correct. Again, possible wave 4 done here, although a possible triangle in play if it's longer. I'm saying we could have started wave 5, but just something to pay attention to going into fourth quarter, then on into the new year. Eventually see the long-term yields end up ticking back up. It's something worth paying attention to because you've got yields rising. And here it is again on the daily chart. And then you have the dollar rising, which again is going to be bad for crypto. If we start seeing the dollar rise and the yields increase, we could see the stock market fall and Bitcoin fall, which is giving us another warning sign, possible warning sign today on the Friday session. Just be aware that we're hitting a parallel boundary on the dollar to the upper boundary here. This is going back to 2008, and this upper boundary right here, we turned off of this area and we've come back down to this lower boundary. I've drawn a parallel boundary to that upper boundary, and we're hitting it right now, getting a doji candlestick for the week on the dollar. But just be aware of this because, again, this is suggesting we could have two things. We could have some short-term volatility coming, and we could have some longer-term volatility coming as well. What performed really good during the crash in 2008? The dollar, right here. Look at that. The dollar performed very good. Well, the stock market crashed. Bitcoin didn't exist back then. Be aware of this channel because look at this. Markets crashed in 2008. We had the Lehman moment and the dollar soared. We had the flash crash in 2010. The dollar soared. We had the Selloff in 2011. The stock market dropped about 21% and the dollar soared. Some volatility in 2014. The dollar went up. And we had the volatility, about a 17% sell-off in 2015-16, and the dollar soared. Two major sell-offs in 2018, first quarter and in the last half of the year, the fourth quarter, and we saw in 2018 the dollar soared. Then recovery remained elevated. With the pandemic, we saw the dollar soar even further. Eventually, the Fed did QE 2.0. We had the stimulus. The dollar turned down. Stock market had a sharp recovery until late 2021. Bitcoin peaked. These are Bitcoin. Bitcoin peaked in 2017, December of 2017. It had volatility in 2018 with the market. Bitcoin and the NASDAQ peak in 2021, late 2021, the S&P in early 2022. And look what happened. The dollar soared. And what happened? The market tanked in 2022. Bitcoin tanked in 2022. We had volatility in early 2025. We saw the February peak and the drop down to the April low, and the dollar increased. We've seen markets now recover, and the dollar's come back down, and now we have this trend line. It's likely something's going to happen here. Could be we get volatility in the market, the dollar rises, and the markets recover, and eventually, coming months ahead, we get a top in the market, don't end up forming one immediately. The dollar is eventually, in 2026, going to be rising up towards this upper channel, and that's telling us, hey, we're likely going to see a major top. It could be where we get some volatility off the lows, and then the dollar pauses and takes its time, and then we get market possibly topping with a higher low with the dollar. That's certainly possible if we don't do it immediately, which is possible, but I think less likely. I think it's more likely we're going to get a good fourth quarter after a pullback. Just be aware of the dollar, because when it soars, we've seen bad things happen on Bitcoin. We've seen bad things happen in the stock market, like the 2022 sell-off, which is here, or the volatility, all the volatility in 2018. It's a monthly chart of the dollar. So just be aware of this, that we're hitting this parallel channel, and the dollar is probably trying to bottom here. It was down for the week, but it was up off of the lows. We had a rally for the last 3 days off of the Fed rate decision. We saw yields rise, and we saw the dollar rise. Some warning signs there. Until on the monthly chart on the dollar, that's the month's not closed yet. Here the week is closed, and we did get a bottoming tail here. We got a doji bottoming tail right here in the weekly time frame, coming up to the trend line. So again, just be aware of this, that the dollar and yields could be suggesting we could see some volatility in the short term and volatility for the long term. When the NASDAQ and Bitcoin peaked back in November of 2021, the dollar had broken out. The dollar soared. Bitcoin collapsed with the NASDAQ following it. Just some warning signs with the dollar, with the yields. Another warning sign for the stock market is Bitcoin. Bitcoin is turning down with options expiration day. It's been down about 1.5%. It's a little bit less than that at the moment, but it's formed a bear flag pattern, which I talked about at great length and detail, and really a rising wedge, possible rising wedge, went up to this trend line right here, rebounded right up to that trend line, right on the nose, hitting the 61.8 Fibonacci from this decline right here. Again, you're likely going to continue the breakdown of this trend line will likely give us a continuation of this right here. We hit the Fibonacci from that low to the high, 98,000 to 124. We hit the 61.8 Fibonacci, and then we've rallied back up to the 61.8 Fibonacci of this decline. So again, right on the nose with these Fibonacci's, just here, just slightly below it here, just right on that 61 Fib, right on the nose there. We're likely pulling back towards the 78.6 Fibonacci, towards the 200, towards the low 100,000. We have a double top pattern that measures to 100,000. This takes us to the 104,000. If we go under the 200 period moving average, we can hit the 50% retracement from the entire advance from the April low. That would take us to 100,000. That's where it's at. If Bitcoin gets another leg down, we're likely going to see the stock market begin to play catch up. Bitcoin often peaks and bottoms before the stock market. Sometimes they do it together, like at the April low, but oftentimes Bitcoin leads. Both risen in September. Bitcoin bottomed out at the same time as the stock market. We rose up in September. Now it's turning off that 61.8 Fibonacci, and the stock market has moved to new high. Bitcoin has not. Bitcoin could be concluding the September rally. 4-hour charts warned me about down here at the bottom. We're getting the negative divergences in the 4-hour time frame up here with Bitcoin hitting our 61.8 Fibonacci. So could Bitcoin be warning that we're about to see a bigger dump in Bitcoin and a dump in the market? I think that's likely. The counter trend very well could be done with Bitcoin. I talked about a possible head fake above this area. That's still possible, but you are turning down with the negative divergence in the 4-hour time frame. If you want to see my latest Bitcoin video, I'll link it at the end of this one. The fact that Bitcoin is now starting to turn down, the stock market could follow suit. In Nvidia, we got a bearish alignment of the moving averages. The 10 and 20 are now below the 50. We've rallied back up to fill the gap after Nvidia sold off here with China banning their chips. And then we get the rally on Thursday with Nvidia right after the Fed, by the way, the Fed meeting. It appears to have been timed. A rally back up to fill the gap. Possible topping tail today. We had more of a gravestone doji earlier in the day. We got a topping tail, but we're above that 50-period moving average. We're filling the gap. We're getting another lower high so far. Slightly overthrowing this trend line right here, but not closing above it. And Nvidia here in the daily time frame, that rally on Thursday, the announcement of their investment into Intel. Intel rallied, Nvidia rallied. That gave us a Thursday rally. It continued on into today. Another lower high. We need to drop back below the 10 and 20 period moving average. We got just above the 50 here. Drop back below the 50 and drop back below the 10 and 20 if they're to remain below the 50 period moving average. Nvidia's dropped 11.25%. Bitcoin's dropped nearly 14%. Both of them peaked back in August, and Nasdaq's now diverging with both of them. Could be a huge red flag for Nasdaq and the S&P 500. It's a warning sign here that we have the bearish alignment of the moving averages for Nvidia so far. We just had options expiration. Another warning sign is the 5-day moving average, red line you see right there, of the put to call ratio, verging with the S&P 500 in the lower window. And again, the put to call ratio shows that options traders are concerned about any kind of sell-off or volatility in the market. They're usually very, very bullish at tops, which is what we're seeing here, very bearish at bottom. So just something to be aware of. Now, the VIX was down 1.59% today. It was it closed around 15.5. The VIX had a down day. It had tried at the highs of the session to get above the 50-period moving average, a green line you see there. We have a compression pattern in the form of a bullish falling wedge. Again, when we get above the 50 period and break out above the trend line there, clearing the upper band, you're likely going to see the market begin to sharply sell off. Pointed out, the stock market's moving to a new high. The VIX is not. There is a discrepancy between the two. This is what we had at the February high, and we had a hollow red candlestick. I talked about it in yesterday's video. We had a hollow red candlestick back at the February high. What did we get Thursday? We got a hollow red candlestick. Those candlesticks are often associated with bottoms for VIX and for the S&P 500 and the NASDAQ. Black candlesticks often associated, but not always, often associated with tops. We got one. Just zoom out here so you can see it. We got one back at the April low. We got a black candlestick. Always play out that way, but oftentimes black candlesticks and hollow red candlesticks are associated with tops and bottoms. All I'm pointing out is you get a hollow red candlestick, you're just under the 50-period moving average, and you have these bullish divergences. Again, when the MACD goes into positive territory, and the RSI bounces here off the 50 or ticks below it and turns back up, whichever way it plays out. Again, holding above 50 here on the RSI, getting above 0 on the MACD, you're likely going to have a breakout and a push above 50. When you push above 50, then bad things are going to start happening on the S&P 500. We have a compression pattern in the form of a bullish falling wedge, and it's building and building and building pressure, and then pretty soon you get the breakout and boom, that's when the stock market is going to get a bigger pullback. We've had these other surges during the summer that have only given us smaller pullbacks on the S&P 500. This is all building for a bigger sell-off. Probably going to be, we're going to get a sell-off and still go make new highs, probably get a good fourth quarter, but then peak either in the fourth quarter, probably around November or December, or if it spills over into the first quarter, probably into January. We're likely going to see a sell-off that is bought, a buy the dip event. With that, we're going to see this compression pattern break out. So hollow red candlestick. If it's to play out, we need to see a push above the 50 period, the green line, and we need to see a breakout. Rallies have been taking us to the 200 period here, and we've been getting rejection there. Eventually, if we're going to have more volatility, got to get above that 200 period moving average. And the trend lines move a little bit when I bring it up close, so keep that in mind. But we've got the 10 getting back above the 20 period moving average. Now they're crisscrossing back and forth, holding under the 50. But the 10 is getting back above the 20 with our hollow red candlestick right here. And again, if we can get above the 50, if we can get a close above it, and then we can break the downward trend line, get back above the upper band here, you can move towards the 200 period moving average, moving towards 19. Likely about to witness that happen. Again, the fact that we're not moving to a new low and the S&P has moved to a new high, there's a discrepancy. This hollow red candlestick very well could be marking a turning point. We're getting a higher low on the VIX, not taking out the previous lows, just like we did right before the February sell-off down to the April low. I don't think we get that big of a sell-off right now. I think we get a pullback. This is suggesting we're going to get a bigger sell-off than what we've seen so far. Just warning signs. The warning signs continue. The 10-year yield rising has a negative correlation with the market. The dollar trying to bottom out. Bitcoin starting to possibly sell off and turn after rallying up in September with the market. And the VIX here getting a hollow red candlestick is resting right underneath that 50 period moving average. MACD is just below the center line. If it turns above the center line, if we go into positive territory next week and we turn back up above 50 here, just slightly under the 50 level on the RSI, if you're above 50 there, which we've gotten above it and we're pulling back to it here, if you can get into positive territory with the MACD, get above the 50 period on the VIX, you're going to start getting a sell-off. Again, rate cuts already priced into the market. The future cuts are now going to be, in question, depending on what happens with the jobs report that's probably going to start improving before it gets worse. The inflation data ticks back up again. Could those cuts be taken off the table with the Fed Fund futures betting markets? Another warning sign to be paying attention to is the divergence between the transports down here and the Dow up here. The Dow is moving to new all-time highs. The transports is not. Transports peaked back in 2021, but the divergence between them, two of them, is potentially a Dow theory reversal signal in that the transports is not confirming the Dow in the more recent price action and in the longer-term trend. So again, a pullback is likely. For now, signals remain bullish. Until signals turn back to bearish, you can't get a reversal until that happens. Negative divergences that are forming in the 15-minute time frame, in the 30-minute time frame, on the 60-minute time frame. We had the sell-offs in mid-August, and then again, August 28th, we had another one. but they didn't amount to anything. It didn't change the signals back to bearish. NASDAQ had some signals turn bearish in August with the sell-off. They've since then turned back to bullish. We formed these rising wedges in the 15-minute time frame. On the 60-minute time frame, you can see it right here, best on the 15-minute time frame. So you've had these sell-offs. Now, as what we did is we had the volatility with the Fed, but it didn't produce a reversal. We go into options expiration and we get this rally, and now that continues on into Friday. Thursday and Friday we got a rally. You've still got the negative diversions. The Fed breaking the trend line, getting back above it. We now have a new trend line to be watching from the Fed low. I've excluded the shadow. We'll have a rising wedge. Bitcoin has a rising wedge or bear flag. I've talked about the rising wedge, the recent highs. You got the same thing going on with the S&P here, rising wedge. Now the black trend line connects this level, slightly overthrew it right here, connects this peak, and we fell shy of that level. We still may try to reach that. The red trend line goes back further, back to the August 28th high, and that connects to our peak from Thursday, and we were just under that today on Friday's session. Just something to be aware of. I'm watching this potential rising wedge and this multiple point negative divergence. You've got it here on the RSI. You've got it on the MACD down here. Again, institutions like to play games around option expiration day. Still believe we're going to get a post-Fed sell-off. Often you'll get a post-Fed sell-off the Thursday or Friday after the Fed meeting, so their fingerprints aren't on it, or as we start the new week going into next week, which is likely going to be the case here. You see it on the 60-minute chart here. Again, we had a little divergence that gave us the Fed sell-off. We now have a larger divergence here in the most recent price action. Got to take out the 50 period. We bounced out the 50 period. You got to take out the 50 period, the green line right there. A little hard to see with the trend line, the lower boundary, the rising wedge. You got to take that out and then take out the 200 if we're going to see a sell-off. So as we go into next week, I'll be watching, do we break down from the rising wedge? Bitcoin is starting the sell-off of the market. The market could be right behind it. September rally's over with Bitcoin. It's likely going to end for the stock market. S&P is going to sell off. It's got to drop back below the 200 period here in the 5-minute time frame. It's got to drop back below the 50 period in the 15-minute time frame and the 50 period on the 60-minute chart. Divergences are setting up on the 30-minute chart. You can see it up here close. The trend lines I've talked about previously in the 15-minute time frame. NASDAQ, we got this rising wedge. Same thing Bitcoin did. Rose up. You've got multiple point divergences. The 60-minute divergences are setting up on NASDAQ and S&P. Bitcoin, that's equivalent to the 4-hour chart with Bitcoin. Those divergences are now playing out with Bitcoin. We're likely to see them play out with NASDAQ and S&P. Diversions here on the NASDAQ is very similar to the diversions on the S&P 500. And these divergences in the 60-minute time frame look just like the divergences that we have with Bitcoin in the 4-hour time frame that are already giving us the sell-off here off of key resistance. And again, bear flag, or if we take the trend line from back over here, you're slamming right into that trend line, possible rising wedge there. I expect the NASDAQ and S&P are going to follow Bitcoin's lead. Did with the rally back up, they rallied together, they're likely going to sell off together. Bitcoin had bigger sell-offs in July and August, often leads, as we only saw a 4.28% sell-off on NASDAQ and about 2.2% on the S&P 500. They rose to new highs. Bitcoin has not. Nvidia has not. That's a huge red flag. These divergences are very similar to the 60-minute charts. I mean, they look very similar to the one here on NASDAQ, the 60-minute time frame, and the ones here on the S&P 500. Got one going on with the MACD down here too. So again, they look very similar. Far these divergences have only given us mild pullbacks. We lose the 50 and the 200, and the 200's been acting as support here, 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 all through the summer. The 200 acted as support even back over here in June. If we end up seeing this divergence take us below the 200 period, again, we're likely headed towards this level, the previous high, maybe beyond that towards the 200 period in the daily time frame. Nvidia is getting a series of counter trends, getting a series of lower highs, selling off as China bans chips, bans Nvidia's chips, and then rebounding with their Intel investment. You're still getting a series of lower highs, and it peaked back in August. While Nvidia has been going down since August, Apple has been going up, and Apple got a 13 countdown sell signal. We got one on the semiconductors earlier in the week. We got a 9 count sell signal along with the NASDAQ the same day. You have a 913 here. And again, while Nvidia has not made new highs, NASDAQ did. Apple helping NASDAQ, some of the counter trends with Nvidia. Got a 13 count today with Apple. So far, Apple's not moving above the previous highs, but we have rallied since August here, going higher, while Nvidia has been going lower. A series of lower highs and lower lows. Just another warning sign here, Apple getting a 13 countdown sell signal. The warning signs continue, yet the market remains resilient. At the 9 count on the NASDAQ, the day of the Fed meeting, we went higher going into options expiration. The Thursday rally on Nvidia's investment in Intel. The 9 count, oftentimes the 9 count will mark a peak, or you overthrow it and it marks a peak. Still likely that we're going to get a pullback with it. We got one with the semiconductors the same day. S&P got the 9 count the day ahead of the Fed meeting, and again we've gone a little bit higher. Each 9 count that we've had through the advance has either produced a pullback or a sideways move. Each one of them has. Sometimes we've gone a little higher, other times we turn immediately with 9 counts as we did over here, but these have been smaller pullbacks. We're likely going to see a bigger one as the market is extremely overbought. Each one of the 9 counts and the 13 nines have led to volatility. This one will be no different. It will lead to volatility. We got to get past the options expiration. And again, perfectly timed rally with the Nvidia announcement right after the bad news with China banning Nvidia chips. Options expiration, you get the manipulation with the institutions. But just be aware of these 9 counts, that they are present and we're overthrowing them right after the Fed day. 9 count, we've got this multiple point negative divergence on the RSI and this massive divergence on the MACD. Prices pushing higher. The MACD is not. Bitcoin and Nvidia have already peaked and begun to sell off. We'll likely see the S&P and NASDAQ follow suit. But so far, signals remain bullish. The pullbacks have been smaller. So again, when we do finally see the divergence play out here, it will likely give us a bigger pullback. If I zoom out, you can see the larger divergence developing, very similar to what we had back over here. And again, nobody thought it was possible we go down over here either. Again, I don't think we're going to get a big dump like this. I think we're going to pull back, go higher, and then I think you're going to get a bigger dump than what we had over here to kick off the bear market. And I think that'll happen somewhere probably in the fourth quarter. Maybe it spills over into January, but likely somewhere in the fourth quarter there, November, December. Because the seasonality sell-off has been delayed, it's likely going to be that this goes into October. You're probably going back towards this trend line, towards the 100 period moving average in the cloud, or our 200 period moving average, which could be at higher levels by the time we reach it. So again, we'll be watching these divergences in intraday time frames, daily time frame here as we go into next week. Looks like they're already starting to play out the divergences on the intraday charts with Bitcoin. See if that's the case with the S&P, the NASDAQ. The hollow red candlestick on the VIX plays out. We start to sell off. Post-Fed sell-off options, past options expiration here. Again, I'll be watching these previous highs. These levels now become support. Longer-term moving averages, the 100 period, the 200 period here for the NASDAQ.